Welcome to the world of financial markets. It can seem very complicated at first. There are so many numbers and charts, right? It is hard to know where to start. But, there is a tool that can help you see the market clearly. This tool is called a candlestick chart. It is a visual way to understand what is happening with prices. Japanese rice traders invented them centuries ago. They wanted to see the story of price movement. Now, traders all over the world use these charts. They help us see the emotions of the market, like fear and greed, in a simple picture. Candlestick charts are very popular for a good reason. They give you a lot of information in a small space. Unlike a simple line chart that only connects closing prices, a candlestick shows you much more. For any period, like a day or an hour, you can see 4 key prices. These are the opening price, the closing price, the highest price, and the lowest price. This detail is very important. It tells you not just where the price ended, but also how it got there. It shows the battle between buyers and sellers during that time. This makes understanding market sentiment much easier for everyone. Imagine you are watching a movie instead of just reading a summary. A line chart is like the summary. It tells you the result. A candlestick chart is like the movie. It shows you the drama. You can see when the buyers were strong and pushed the price up. You can also see when the sellers took control and pushed the price down. This visual story helps traders make better guesses about what might happen next. Learning to read these charts is like learning a new language. It is the language of price, and it can open up a new way of seeing the financial world for you. For a beginner, this is a fantastic place to start. You do not need complex mathematical formulas. You do not need expensive software. You just need to learn how to read the shapes and colors of the candles. Each candle is a piece of the puzzle. When you put them together, you start to see a bigger picture of the market's direction. This guide will walk you through the basics. We will look at what each part of a candle means. We will explore some common patterns. Soon, you will be able to look at a chart and understand the story it is telling you. Let's look closely at a single candlestick. It has 2 main parts. The first part is the thick rectangular section in the middle. This is called the real body. The body is the most important part because it tells you about the main price movement. It shows the difference between the opening price and the closing price for a specific time period. This could be 1 minute, 1 hour, 1 day, or even 1 week. The size of the body tells you how strong the price move was. A long body means there was a big change in price. A short body means there was very little change. The color of the body is also very important. It tells you the direction of the price. Usually a green or white candle means the price went up. This is a bullish candle. On a bullish candle, the bottom of the body is the opening price, and the top is the closing price. A red or black candle means the price went down. This is a bearish candle. On a bearish candle, the top of the body is the opening price, and the bottom is the closing price. So with a quick look, you know if the buyers or bulls or the sellers or bears won the battle during that time. The second part of a candlestick are the thin lines that stick out from the top and bottom of the body. These lines are called wicks, shadows, or tails. The wicks show you the highest and lowest prices that were reached during the time period. The line above the body is the upper wick, and its top shows the high price. The line below the body is the lower wick, and its bottom shows the low price. These wicks tell a story of their own. They show the price extremes that the market tested but could not hold on to before the period closed. Long wicks can tell you about uncertainty or a reversal. For example, a long upper wick on a candle means that buyers tried to push the price much higher, but sellers came in and pushed it back down before the close. This shows that the sellers are getting stronger. A long lower wick means sellers tried to push the price down, but buyers fought back and pushed it up. This shows buying strength. By looking at both the body and the wicks together, you get a complete picture of the trading session's psychology and power struggle. Once you understand a single candle, you can start to look for patterns. Patterns are made of 1 or more candles. They can give you clues about where the price might go next. One of the most important single candle patterns is the doji. A doji looks like a cross because its body is a very thin line. This happens when the opening price and the closing price are almost the same. A doji shows indecision in the market. Neither the buyers nor the sellers could win. When you see a doji after a long trend up or down, it can signal that the trend is losing power and might reverse. Another powerful single candle pattern is the hammer. A hammer has a short body at the top and a long lower wick. It looks like a hammer. This pattern usually appears after a downtrend. The long lower wick shows that sellers pushed the price very low. But then, strong buying pressure came in and pushed the price all the way back up to close near the open. This is a bullish reversal signal. It suggests that the bottom might be near and the price could start to go up. It is a sign of hope for the buyers after a period of falling prices. Now let's look at a two-candle pattern. This is called an engulfing pattern. A bullish engulfing pattern happens after a downtrend. It consists of a small bearish candle followed by a large bullish candle. The body of the second candle completely engulfs or covers the body of the first candle. This pattern shows a dramatic shift in momentum. The sellers were in control, but then the buyers came in with great force and took over completely. It is a strong signal that a new uptrend may be starting. The opposite is the bearish engulfing pattern, which signals a potential move down. These are just a few of the most common patterns. There are many others like the morning star, a three-candle bullish reversal pattern, or the shooting star, a bearish reversal pattern. Learning to spot these patterns on a chart takes practice. You need to look at many charts and see how these patterns played out. It is important to remember that no single pattern is perfect. They are clues, not guarantees, but by recognizing them, you are using the same techniques that professional traders use every day to analyze the market's behavior and sentiment. Learning about candles and patterns is the first step. The next step is to use this knowledge to make trading decisions. Traders use candlestick patterns to help them decide when to enter a trade, where to place their stop loss, and when to take profits. For example, if a trader sees a strong bullish engulfing pattern at the end of a downtrend, they might decide to buy. They see this as a signal that the price is likely to start moving up. It gives them a reason to enter the market with more confidence than just guessing. Context is very important when using candlestick analysis. A pattern is much more powerful if it appears at a key price level. For example, a hammer pattern is a good bullish signal on its own. But a hammer pattern that forms at a major support level, which is a price level where the stock has stopped falling in the past, is an even stronger signal. This is called confluence. It is when multiple signals point to the same conclusion. Traders look for this confluence to increase the probability that their trade will be successful. They combine candlestick patterns with other tools like support and resistance levels. Using candlestick patterns also helps with managing risk. When a trader enters a trade based on a pattern, they also know where the pattern would be proven wrong. For instance, if you buy after seeing a hammer, you might place your stop loss order just below the low of the hammer's wick. If the price goes down and hits that level, you know your analysis was incorrect. This tells you to exit the trade with a small, manageable loss. This is a crucial part of successful trading. It helps protect your capital so you can trade another day. The best way to become good at candlestick analysis is to practice. Open a charting platform and look at historical price charts for different stocks or currencies. Try to identify the patterns we discussed. See what happened to the price after the pattern appeared. You can start with a demo account, which lets you practice trading with virtual money. This way, you can build your skills without risking real money. Learning candlestick analysis is a journey, but it is a skill that will serve you well. It provides a solid foundation for understanding the heartbeat of the market.